All right, welcome everyone. We got a great whiteboard topic because the peoples wants to know. They wants to know, what am I supposed to do in a market correction? How am I supposed to make a living trading in a market correction when stocks just keep going down? Should I sell all my stuff? Should I run for cover? Should I get a bug out bag and a doomsday truck and head off into the woods? No, you shouldn't. I know that's a bit dramatic, but hey, I think you understand what I'm talking about because I understand. I'm getting a lot of questions here lately about that. And for a lot of you, this is the very first market correction that you're seeing. And if you started trading as late as 2009 or 2010, you haven't seen anything remotely close to what you're seeing right here. And if you want to be a professional trader and you want to do this and make this a career, this is something you're going to have to learn how to embrace, because if you're fortunate enough and it lasts for several decades, then you're going to experience several different corrections, no matter what the pundits say, no matter what the financial gurus say. It's the market. It goes through cycles, bullish, bearish, and back and forth. So some of you are experiencing this for the first time. Now, as we've hinted before, in these past couple happy hours that I was doing, also the market mutterings, you want to be able to trade through this time because these present some of the very best opportunities that you will ever see in trading. And I know a lot of traders right now are saying, I'm sitting on my hands. I don't know what to do. Now, if you're an investor, that's cool. You can sit on your hands, as we talked about before. But if you're a trader and you're trying to pay your mortgage company doesn't give a damn what the market's doing. They want their money, right? So you've got to trade. And as like I said, if you understand what you're doing and you know what you're looking for, you really can make a lot of money. You'll find these markets present some of the greatest opportunities. So let's talk about that. The very first thing that you need to do is be selective, okay? And I mean being selective with the type of trades and the amounts of opportunities. Now, it doesn't matter what your strategy is. That makes no difference. If you're a bullish breakout buyer, if you're a bear flag shorter, if you're a parabolic shorter, if you're a flush out waterfall dip buyer, it doesn't matter. Whatever fits in there, whatever kind of strategy you use, they still are there and present in bearish markets and corrective markets. However, there are less of them and they work a lot differently. So for example, we'll use a breakout buyer. That's not what I am, but maybe you're a breakout buyer. So we're all on the same page for this demonstration. If you're a breakout buyer, over the last couple of years, you've had a lot of opportunity because there were a lot of stocks going up. The market was linear. We had one of the biggest bull runs in history. So if you missed an opportunity early on, there usually was one to follow it up. Or most setups worked, within reason. They had a high percentage of working. But you'll find out in this market, well, there still are breakout. There will always be breakout stocks in bear markets. There'll be flush outs in bullish markets. You just need to be more selective with the type of trades that you take, because not all of them are going to have the same success ratio in working. So what you have to do is only take your tier 1 top setups where you are able to control your risk and something that feels comfortable. Now, I can't really elaborate too much on that because each and every one of you are going to have a strategy that you use. And you know what I say when I say tier 1. If this is the first time you're watching this video and you're a new trader and a little yellow behind the ears perhaps, a tier 1 is just a ranking of your trades. So when you have a trade, we talked about this, I did a whiteboard a while ago, tier 1, 2, and 3, and that separates the quality of the trade. So if you've already are trading and you have a strategy, you know what a tier 1 top quality setup looks like. So in this type of a market, you have to take only those tier 1s. You basically do not have any gambling money or house money or side money that you should be using. Maybe you do, but you shouldn't be that. You should be very selective. The second thing that we're going to talk about here that you should use, stops, and of course size. And I'm going to take this from a risk on to a risk off. That's not even how you spell risk. Sorry. I was just getting ahead of myself. I stuck an O in there. Standpoint, okay? Now, what I mean by this is, let's go back to the first one, being selective. You know what kind of strategy that you have. Now, there are market environments that allow you to be risk on, risk off. So let's stay with that bullish breakout buyer, for example. So over the last couple of years, you had a risk on strategy. And what that means is the market was playing into your favor. It was giving you a lot of opportunities, it was being generous with those opportunities, and it was playing favorites to that kind of opportunity. Therefore, you could use max risk. When I talked about just a minute ago, tier 1s and 2s, you could take 2s and 3s because most likely those lesser quality trades would work. Those dip buyers out there, risk on. That market has been like that over the last couple of years. So when you're a trader, one of the things you do have to understand is when is the market risk on and risk off. Now, if you are in this, if you're in the environment now that we're in, you're in a risk off because not every single one of those are going to work out as well, and they're probably not going to be as sustained. So if it's breakout buying, for example, you may be used to getting runs that last all day where now they may only last 10 or 15 minutes. It's from a risk on and risk off. Now, how you actually handle that is first, you must pick your shots and respect your stops. You have to use stops in this type of market now. You have risk management really has to take a priority. It always should be a priority, but it has to take a priority over everything else because we're seeing amazing moves in stocks, such as, for example, if you're a trader of Tesla or Nvidia, you know, a few months ago you could trade something like that and pick a spot and get your risk down to $1. You're going to have a hard time doing that because you're seeing that thing move around $3 to the upside, $3 to the downside. So you're going to have to respect your stops. Now, to counteract using stops, you have to loosen that a little bit. You have to keep a little bit wider stop because of this erratic market and the volatility that's in it. And the way that you compensate through that, of course, is size. Size controls risk on and size controls the risk off. Okay, size, position size is what makes the difference. So for example, if you're making your trade and you're used to risking 30 to 40 cents on the stocks that you like, just for an example, maybe that stock right now is 80 cents to $1 of risk. It's okay for you to still to make that trade and use that wide stop, but compensate for it by position size. However, you can't afford to be flexible with that stop once you've drawn that line in the sand because you're in a risk-off market. Now, how to tie this in, let's say you're a dip buyer, okay? That's the strategy that you used. In the risk-on market that we've experienced over the last couple of years, if the stock came down into support and then it just slightly broke support, you could give it a little bit of flexibility underneath of low a day, for example, because in most cases, stocks would snap back and go a little bit higher. We saw that behavior. That's where the BTFD slogan came into play. We would see that. Well, now when the market's going down maybe 700 points in a day, you can't afford to do that because like I mentioned, Tesla and Nvidia, you let that go. I mean, we had Friday alone, you had a $19 swing. You had $19 up on Nvidia, $19 down, and then it came back 6 or 7. So you've got to pick your shots and respect your stops. And the last thing, I say it all the time, guys, learn, observe, and learn. No matter what happened, if you're struggling with your trading, you're getting stopped out a lot. Your strategy's really not working right now. You've had to make adjustments. And I understand because it seems like it's overnight. It's only been a couple of weeks, but you've been doing something, you've been complacent, things have been going well for a couple of years, and all of a sudden it's just like, ah, damn, I got to change everything on a dime. You got to do that if you want to be a trader. But that made a little bit more noise right there. So you've got to be able to do that kind of stuff as a trader. You got to be able to change. You got to be flexible and all that. It's going to happen over and over again, but learn from it. Now, I've told my story before. I'm not going to bore you out with it, but to give you an example, I just blew up in 2001. You know, I got stuck in the .com. I wasn't paying attention, you know, and I just blew up. But even though I lost my account, lost my money, and I was out of the business at the time, you know, I eventually got back in. But when 2008 came by and we went through the financial crisis, all the lessons that I learned back here, all the pain, the crying, the punishment, the snot coming out of my nose, just the hate, the regrets, I took all of those lessons and I put them into play. And this still, to this day, was the very best year I've ever had as a trader because I remembered exactly what a bear market flush looked like. I remember what a correction looked like, and I was able to capitalize. Yes, it was 7 years later, but I remembered. And if we even come out of this when we go to all-time high, you remember because it will happen again. Now, I can't say that's going to be like an 08 or 01. You know, this is just the first couple of weeks. We still have a couple of signals that still need to go. These were extended corrections that lasted, a good amount of time. So we're only in a couple of weeks here. Is this something that's going to last the remainder of the year? We're going to see new lows. We don't know that yet. But we're still in the early cycles of people trying to figure this out. So the point in all of this is while everyone's trying to figure this out, you've got to be selective with the opportunities that you take. Make sure they're only tier 1 and they're great setups where you can control your risk by using stops and get your size down if it's too much risk for you to take. Okay? Because you're still in a risk-off environment. You can't afford to get risky right now until things clean up. And no matter what, day in, day out, you continue to learn. So I hope some of this helped you. It's a difficult time. I know for some of you, you need some help. Visit thelincolnlist.com. Join us live each day and trade with us. Until the next one, thanks a lot. Appreciate it.